Well, hello, Switzerland, and welcome to your weekly neoclassical TA broadcast, where we go where no one else goes, and that is we go to the charts. We use neoclassical concepts to read supply and demand, and we read it on the charts. We're always searching for direction, for qualified trend, and for timing. We look for tests of swing points, of anchored and retest regenerate zones. With our wind at the back, the trend, and with our timing entry and exit, we can consistently outperform the markets, and profit by them. So let me give you a tour today. Towards the end of the show here, I'm going to look at some of the charts with you in terms of direction, what's happening. But I actually want to take a few minutes here and show you something. If you come in and you're on the site, if you go to the tools and you've logged in, you can come to a number of tools here. One that I use all the time is watch list. If we look at the watch list, right, you can pull these up. I've got the general market up. This is a shared watch list, so you can see my watch list. It has all the major indexes. And if we pop in there and look at these indexes, right, we can pop up the charts on those indexes. And one of the things I wanted to show you is if I come back over here and go to market view, there's actual trends that give you a synopsis of what the trend is, the qualified trend. And in neoclassical, we qualify it, right? Not all trends are created equal. Some are different than others. And what you need to do is understand what that difference is, because it has a bearing on the believability and the longevity of that trend once it's in play. Green denotes confirmed, red denotes suspect. Difference is volume when it breaks out. If you have enough volume compared to what you're breaking out against, it gets a green. If you don't, it's suspect. What's the difference between them? Well, suspect has a lower longevity. It's going to die sooner in terms of a trend, right? The mean time to failure on that trend is less. And so that's important to know. It's not a huge difference, but we're talking 2 to 4%. 2 to 4% can mean you make money or you don't make money. And so anyway, if we look at the qualified trends here on the general indexes, and I want to just focus on those. If we look at the SPIX, which represents the broadest market index of the Switzerland market, right? It's confirmed bearish on the short term. Also on the intermediate term, all indexes remain bullish, or at least sideways to bullish on the long term. So, when I'm looking at something like this, what I'm saying to myself is, hey, long term, these things still haven't broken down. On the intermediate term, very different picture, right? They're all bearish or sideways. And if we look on the short term time frame, you've actually got bearish to sideways on most. The only one that's different, of course, here is the SPIE-XX, which is your small cap a portion of the market. And last week we were talking about if you're going to be in the market, that's where you want to be. And so you can use the qualified trends to quickly tell you, is there a part of the market you want to be in or not be in? And right now, when we look at the Swiss market without looking at anything else, we can tell we probably still should have exposure, and we should have it in this area in particular, right? SMI potentially because it's sideways, but overall, the juice is here in the small caps. So that's one way to look at the market, right, in terms of trend. But trend doesn't move on its own. In other words, the market trend for the general market, that's based on the sectors. In other words, if we're looking at how this works, and let's just envision, even though I don't have them down here, let's envision that down here is the stocks themselves. Right? So we've got stocks here at the bottom, right in here. We've got the sectors here, and we got the general market there. How does it work? Well, if enough stocks start to move, right, and we get enough of these stocks moving from, say, bearish to bullish, then eventually that's going to take place, and they're taking place in the various sectors, right? Then eventually, if enough of them in the basic materials move, then the basic materials is going to switch from bearish to bullish. And so it's a top-up type approach where you start at the bottoms-up approach where you start at the bottom, you work higher, and then it eventually goes, and those changes here, depending on the weighting structure, right, eventually affect the indexes themselves. And so you start with the stocks move the sectors move the indexes. And it's important to understand that relationship. But it's also important to understand another relationship, and that is that the short-term time frame moves the intermediate-term time frame, and the intermediate-term time frame moves the long-term time frame. And what I'm saying is if you stay bearish long enough, eventually you're going to drive these lower as well. And typically on the long-term trend, when you get 2 to 3 of these turn bearish, and right now you have just one. You got 2. When you get 2 to 3 of them, right, so it's on the verge. You've got one here, the financials that are sideways and they've been getting beaten up. Healthcare the same. If you get another one, you're probably going to see this long-term trend start to change up here, not just down in the sectors. And so that's something that's concerning. So if I'm looking at your market and I'm saying, where do I want to be? I want to be in the small caps, but I really want to watch what's happening in these sectors to see what crumbles, because at some point this is going to move this if it starts to change enough. So that's a good introduction to trend. We'll tackle some of these concepts as we go, but as far as what we're doing tonight, let's take a quick look at what's happening in the market. And we'll start here with the broadest measure, the SPIX. And so when we look at the SPIX, right, you've got, I'm on a daily time frame to start with, you've got a push up last week. It held pretty well, pushed up, coming back into this big bar. The volume is on that bar. That was a quad witching bar in the States, and for whatever reason, and I've never really dug into it to understand it, but in Europe, it also usually gets high volume. So you're coming into that bar. Top of that bar is going to be the difficult spot. You got swing point highs just above it, and we'll talk about swing point highs at some point, but essentially swing point highs and lows, right? There's the L. You have to break a swing point in order to change the trend. If we're looking for what the trend is on this particular index right now, it's bearish. And it's bearish because this swing point low was broken. Our prior swing point low was broken. And we'd have to, look back over here to see what the swing point low was. It was broken here. We went bearish there. Another one that's off the chart went there. You can see it with the green arrows. Confirmed, had the volume, right? As it broke, it had enough volume. That changed it, and so far we haven't gotten back over a swing point high. So we're bearish on the trend. Now a lot of folks do, that do technical analysis, do these kind of trend channels and all that. In TA, neoclassical, we only look at horizontal lines. We don't look at vertical. We don't look at angles. The only angle we look at is when we're trying to say, what's the angle of ascent, so that we can measure how fast a move has done, right, in compressed time. And so at this point on the daily chart, you're just coming back into an area that's probably going to give it trouble, up around 506 it looks like, into the top of that breakdown bar around 507. Now, if we go to the weekly and we take a look at how the weekly shapes up, right, the weekly, you can see the weakness that's in this index, and this is where you begin to get it. And there's a concept that we call retest and regen, and that says is that once you break down, and we did here, you can see it on that arrow, you're going to try to push back up and then regenerate to the downside. And that is what you saw take place here, is this bar, once it broke, you got the little push back up, and then it just regenerated right to the downside. And so we saw, this move down, continue, and that gave us the next spill, right? Now what it didn't do is it didn't move too far. As it came back up, it bounced into that area and again gave it back up and is trying to regenerate lower. And so right now we're at a point where this market, we can see it's weak. We can see that each time it comes up, it continues to get pushed down. And now you've actually got some bars that you can work with that are important. For example, if I look at these two bars, they're wide price spread bars. That little overlap is going to be a hard area to get over it. And so as it comes back into it, that's an area that we'll test. This swing point low also is part of that area. right, towards the top here. That's going to be a difficult area. And so if we want to judge what this market's going to do, we want to look into these areas and say, what happens when price push back up? Do the sellers disappear? Do the buyers disappear and the sellers appear? Right? That gives you information. That is where you find the supply and the demand here on the charts. And that's how you get a read on what's really happening in these markets, right? That is the essence of supply and demand on the chart. Supply and demand, as it comes back into the area, the test takes place. So right now, on the broad market, you don't want to mess with it, right? You're in a bearish position on those 2 time frames. And on the weekly, another concept, we'll talk about all these more and more. You got a swing point low here, another one there. So there's 2 of them close. If it breaks, it's going to break fast and furious. That's another reason to be very careful about this market. If we look at the strong part of the market, right, if we go to the SPIEX and take a look at it, what we're going to see there is that strength that we were talking about. I'm going to pop up, and you got a swing point high broken on Friday. That's a good sign. So a reconfirmation of trend, although it was suspect. It's coming after a swing point high that has volume. I think that's going to give it trouble. We'll see if it gets over it. That's going to be the next key spot. If it can get over it, then you've actually got a nice ABCD structure that's a very strong one, right, that projects way much higher if it can get over this swing point high. So all of that looks good. And finally, if we look at the monthly, you can see it continuing up. So right now, if you're in the market, you want to stay in this group. And as far as other groups, you want to stay away from them for the most part. Next week, we'll look inside this along with some other concepts and talk about how we find good entries inside groups that we like. That's it for tonight. Thanks for joining me. Have a great one. I'll see you next time. Good night.